Institution Mobile, quality e-learning experience on the go.
What is a company? A company is a legal person or entity created by the association of a number of persons in accordance with the law for the purpose of a defined objective. Limited liability companies in Nigeria are formed under the Companies and Allied Matters Decree of 1990. Types of limited companies. Limited companies can be private or public. Private company. For this type of company, the minimum membership is 2 and the maximum is 50. It is the most common type of limited liability company. First, members are restricted from transferring their shares. Second, the number of members are limited to 50. These members does not include the employees. Third, the company is stipulated by law. It cannot invite the public to subscribe for any of its shares or debentures. 1. The minimum number of members is 7 with no maximum member. 2. The company can invite the public to subscribe to its shares. 3. There is available market for the purchase or sales of the shares. Before a limited liability company is formed, certain documents have to be filled and filed with the Registrar of Companies. If the regulatory authority is satisfied with all the documents presented, approval is given for its formation and a certificate of incorporation is issued, which brings the company into existence. The documents to be filed are 1. The Memorandum of Association. This must contain the following particulars: the name of the company, the address of its registered office, the object of the company, that is, what the company intends to do, the fact that its members' liability is limited, the amount of its share capital, divided into classes of shares. The second is the Articles of Association. This spells out the internal rights and duties of the members of the company. Other documents include statutory declaration. In the case of a public company, the written consent of each person, that is, each member, to act as a director, together with an undertaking to pay for any qualification shares. The main classes of shares are preference shares, ordinary shares, and deferred shares. Preference shares carry a fixed rate of dividend provided profits are available to pay it. They are preferred because their dividend must be met before an ordinary dividend is paid. In the event of the company closing down, they may also be preferred in repayment of capital. They may also be preferred in the payment of capital where the business or the company closes down. Classes of preference shares. We have non-cumulative preference shares and cumulative preference shares. It is non-cumulative if there are sufficient profits to pay a preference dividend. The preference shareholders will therefore benefit, but if the profits are not enough, the dividend is lost in that particular year, and the opposite is cumulative preference shares. Redeemable preference shares. Here, under the law, a company cannot buy its own shares. However, in the case of a redeemable preference shares, the company is empowered to repurchase them at a predetermined date. The redemption must take place out of the proceeds of a new issue of shares or out of profit. Ordinary shares. These are the most common types of shares. It is sometimes referred to as equity. They carry a fixed rate of dividend but are only entitled to participate in the residual profit after payment of dividends on preference shares. Deferred shares, which is the third one. This type of shares are not common. They are occasionally issued to founders or directors of the company. They rank last as regards dividend or repayment of capital. Capital can be classified basically into four. We have authorized share capital, issued capital, called up capital, and paid up capital. Let's note the important terms under issue of shares and debentures. The first is application. When sourcing for long-term funds from the public company will usually request the members of the public to make offer, that is, to buy its shares or debentures. The application money is not a guarantee that they will receive shares. Any unsuccessful application will have their money returned. The second is allotment. When the directors have fully accepted the applicant's offers, shares are now issued or allotted to those successful applicants. At this point, there's a binding contract between the company and the public. Cause, where the total amount due is not collected at application and allotment stages. At a future time, when funds are needed, further requests will be made to successful applicants to bring in more money until the shares are fully paid. Major accounting entries. 1. When monies on application are received, what do? You debit bank account and you credit application and allotment account. Second, when shares are allotted and allotment monies received, you debit bank account, credit application and allotment accounts. Third, when monies are returned to unsuccessful applicants, debit application and allotment accounts, credit bank accounts. Note that shares can be issued at premium and at discount. When shares are issued at premium, premium on shares will be the difference between the nominal value of each share and the issue price. When shares are issued at discounts, the value is lesser than their par value. It is very rare to issue shares at discount. Before it can be done, the following rules must be complied with. The issue must be approved at a general meeting by the members. 2. The company must have been trading for more than 1 year. 3. The shares must be issued within 1 month of the court's sanction or within a period specified by the court. 4. The maximum rate of discounts must be specified by members. What is a ratio? A ratio shows a relationship between figures. Basically, the major accounting ratios are gross profit percentage or gross profit margin, markup, net profit or sales ratio, returns on capital employed or returns on investment, liquidity ratio, credit control ratio, gearing or leverage ratio, and stock market ratio. Let's take some of this analysis. The first one, gross profit percentage or gross profit margin. The ratio shows the rate of gross profit at every 1 naira of sales. The amount of gross profit realized when 1 naira worth of goods is sold. The formula is gross profit divided by sales times 100%. Note, sales is equal to cost of goods sold plus gross profit. Note, sales is equal to cost of goods sold plus gross profit. The second one is markup. This is the percentage of the cost price of goods or services that is added to the cost price to get the selling price. Markup is equal to gross profit divided by cost times 100%.
Fusion Mobile, quality e-learning experience on the go.